Hello, everyone. Thank you, Kevin, and thanks to all the excellent presenters so far. I hope we can live up to that. Just before we started, I wanted to say a few words about Jim Lawrence. This is the first one of these I've done without his beaming features looking up at me from the audience, and he was the guy who got me involved in this in the first place. And I think we all miss him very deeply. Everyone who met him knows that he was a unique contributor to our industry, and we feel his loss very much. So we miss you, Jim. Now, I think Jim would have enjoyed this panel. It looks technical, but I think it involves a lot of the soft elements of shipping, and it's to do with the disconnect between prices and earnings and what is going to change that. And I don't want to panic the panelists, but I've brought along my mini calculator here, and I'll be vetting your answers regularly. I don't know if anyone travelled here by the Underground today, by London's wonderful tube system, but it regularly broadcasts the message, mind the gap. And I think that's relevant today, and it could be a motto for investors in our industry. Regardless of that, and since this panel was put together, we've probably seen more deadweight tons sold and bought than we have in any month in history, given an audacious move by some Korean ship owners and MSC's continued acquisitions in the container market. So what are the factors driving these audacious moves, and what will cause a correction? So to help me solve this mystery, I've got a great panel here, which I'll ask to introduce themselves just briefly. So first, Alex.
Well, thanks, Jamie. Good afternoon, everyone. I'm Alexandra Alatari, representing SSY Global here today. I'm a senior analyst in the sell and purchase department, and that means our focus is quite cross-sectoral. It's not simply focusing on dry or tankers, although those sectors usually see the most liquidity in the S&P side. And what we do is more projects. Really, it's a more client-focused approach than your typical shipbroking house research. So hopefully we'll shed some light into your questions today.
Yep, I hope so. Kenneth?
Yeah, my name is Kenneth. I'm CFO of a 45-year-old dry bulk company called Western Bulk. We operate about 120 vessels across segments from everything from handy through super ultra and up to Kamsarmaxes. And by operating 120 vessels through a global fleet, we fix in about 500 to 600 different vessels a year, giving us a unique insight into vessel performance, I think.
Great. Finally, Simon.
Hi, I'm Simon Ward, and I'm a ship sale and purchase broker. It sounds like I'm addressing an Alcoholics Anonymous meeting, which is probably the same thing, let's be clear. I am director of URSA Shipbrokers based in Greece, and I'm a sale and purchase broker. We have dry cargo chartering as well there. I'm also quite heavily involved in shipping education with my work with the Institute of Chartered Shipbrokers, and also guest lecturer at various universities in Greece, here, and in China as well. So I think about these things too.
Great. So we've got the analyst, we've got the CFO, and we've got the professor stroke broker, which is...
Stroke alcoholic.
Stroke alcoholic. Anonymous. But first I'd like to start with you, Kenneth, to kick this off and to challenge the title. Do you think there is a disconnect between earnings and prices, and what are the causes of that?
Depends a bit which segment you're looking at. My expertise is within dry bulk, and for dry bulk, I think you have to separate a bit between the new builds and the second-hand tonnage. I'm definitely not as pessimistic as Adam before us. I think there is more potential in the market. New builds seem a bit expensive if you look at the FFA rates in particular. I think there's been a push on that because there's a lot of capital available, owners pushing for market shares and also fleet renewals. But on the second hand, there are still opportunities, I think. I think the A 5-year-old vessel can earn the same almost as a new build. You get the optionality if the market spikes, and I think the market balance is the utilization is creeping upwards, getting close to 90%, I think, at least. That said, you also have on top of that, if you have inefficiencies, that will drive spikes. So I think it doesn't really just help to just look at the FFAs or look at the forward earnings. You have to be there for the spikes, and that's why I kind of believe in the second-hand values. But you have to look at buying the kind of the right vessels by assessing the performance. That's my key.
Sure. Let's home in on the different sectors. And Alex, you cover all the sectors, I believe. So which of the sectors that you cover have the biggest gap between prices and earnings?
I'd also say it's bulk carriers, actually. We've seen some crazy price movements on tankers over the past week, probably. But when it comes to the disconnect, I think it's the clearest on dry bulk. To put some quick numbers on it, look at Capesizes. Rates for the past few months are roughly in line with 2022 levels. That was the tail end of the pandemic upcycle. But Capesize values today trade some 30% higher. Owners' confidence can be justified by some genuinely tight fundamentals in that sector, but it's also fair to say that some of that value appreciation is pricing in upside that hasn't fully materialized, not yet anyways. If you look at smaller segments than Kamsarmaxes, Ultramaxes, their values are very close to 2022 levels, but back then rates were roughly double. Here the disconnect has more to do with liquidity and investor appetite and a more affordable entry point, if you like, in a market where, as Kenneth said, lots of capital is available, whether it's cash after several years of simultaneous upcycles across all sectors, or financing. Capital is not panicked, so prices stick. If you look at tankers, yes, values have surged a lot, but they are backed by very strong spot and period markets. Container ship valuations might be a bit hard to justify unless you're a liner. Gas and offshore still present some really interesting opportunities, and they're increasingly catching the eye of many traditional ship owners, but still for most of them, they remain far too complex and illiquid.
Perfect. Before we come to you, Simon, I saw a twitch, Kenneth.
Well, just thinking of the valuation of the dry bulk vessels, I think just looking at the TEC rate, you need to look beyond that. And I think the aging of the fleet plays in quite a bit. Average age of the fleet, dry bulk fleet now, I think reaching 13 years of age now. It's the highest in 15 years. Expected to reach 15 years in 2030. I think 17% of the fleet is now, during this year, the 20-year-old vessels will amount to about 17% of the fleet by end of this year as well. So that, it goes into, so that makes it not directly comparable also to how it was back in 2020. And I think 2020 was a short spike. I think now there are the demand fundamentals playing into it where the ton mile is really driving it. West Africa, that impact is really there. And yeah, I'm not as negative as some also when it comes to coal. I think it was good arguments earlier on India also supporting the coal, and there's also demand from the agris and others as well. So I'm rather positive. Yeah.
Just to challenge the coal point, I read yesterday that last year was the first year that coal-powered generation in India and China dropped for the first time since 1970. So I just wanted to give an alternative on the coal story. But anyway.
I'm not saying that's going to drive it, but I think some analysts think that's on a declining road. I'm more for a stable.
Okay. Simon, you'd flog anything that floats as a broker. So how do you justify that?
Well, from a moral and ethical point of view to you, I have to keep up my alcohol consumption.
Just numbers, okay? Just numbers.
Look, I think, first of all, sell and purchase broking, I mean, you're right, I'm a sell and purchase broker, but I'm looking at it from a different point of view from the owners and from the analysts and for the crossovers. Ship values are set by willing buyers and willing sellers at any particular time on a ship. Shipbrokers don't drive those values. They are basically satisfying the demand and negotiating, because shipbrokers get paid on success. And this is how I justify my living, because we're always acting on behalf of the clients and what they want to do. Of course, there is a disconnect between ship sale and purchase values, whether it's new building or second-hand, as against current earnings, because we're talking about, first of all, gap in timing, and we're also talking about the difference between now and the difference between the future and where things are. Now, I've been invited very kindly here to Marine Money. I'm not sure I'm going to be invited again, but one of the reasons for the disconnect is that there is so much money around at the moment, and that money has to be used, whether it's from ship owners, whether it's from corporate balance sheets and shareholders saying you've got to do something with this, whether it's from the financial institutions themselves who need to make use and stay in the market of this. I used to work for HSBC Shipping Services, who are conspicuously absent from Marine Money these days of any time, but there is a lot of money out there that needs to find a home. What does this mean? This means the prices go up, especially when sellers have no reason to sell in the current environment. There's no bargains, there's no fire sales happening. What's going to happen? The prices are going to go up. The freight market is a different thing altogether. And it's my strong personal and practical view, because this is what I'm fighting against every day.
Sure. Kenneth, did you want to come back on that?
I agree on that. There's a lot of capital available. I never had so many accessible financing from banks as before as well.
Alexandra, so part of your job is also looking at the residual values of ships. And I just wanted to ask, and it's a slightly difficult question, but how strongly does the shadow fleet phenomenon affect your calculations of residual values? And what's going to change that? Is it happening now with the reflagging to Russian flag and the Venezuela, issues? What's going to happen there?
Well, it plays a crucial role, really. I absolutely agree. And for anything to change, we would have to see the geopolitical landscape change first. Let's take a look at the fleet first. Over the past 4 years, we've seen a massive exit of older conventional tankers to the shadow trades. And the extent was so big that today 40% of the 20-year-old plus product tankers and about 80% of crude tankers over 20 years old are either sanctioned or effectively part of the dark fleet. The remaining are either on regional trades or doing floating storage, typical employment opportunities right before recycling. This exit to the dark fleet has come in waves. Whenever buyers emerged to the market, they had to pay top dollar to secure assets, especially very promptly. And that's what's driven the dramatic surge in values in recent years. In the past few months, we see a tougher stance on sanctions. We see more individual ships, more refineries receiving ports, oil producers being targeted. And that's why we see these buyers emerging back in the S&P market. Nowadays, they're looking for older tonnage with no sanctions exposure that can accommodate trades that the dark fleet currently struggles with. And the thing is that there's not that many ships left over 20 years of age. So they have to shift their focus to younger tonnage. We see them focusing on 19, 18, 17-year-old crude tankers these days. So that's driving pricing not just for the overage tankers, but for relatively younger ships as well.
What's your perspective from the S&P market?
I think also there is a dwindling pool of people that want to sell into the dark fleet. I mean, a lot of the ships have already been sold, and there's very few people in my environment anyway, that, okay, there's dark, there's grey, there's different nuances on all of this, but generally the appetite to sell into the dark fleet, whatever the number is, has been softened by the fact that there's other money to be made elsewhere.
So, connected obviously is the geopolitical, I think we'd call it chaos, wouldn't we, for the last few years? And I wanted to ask you, Kenneth, shipping has become used to benefiting from every disruption that's thrown at it, from COVID to the Ukraine war to Red Sea closing, it's all been upside. Is there a level of disruption where that stops and it reverses? And what is it? And when?
I guess it depends what kind of, whatever happens, I think. As you say, we've been kind of lucky up until now on that front. I think, where it turns is when disruption kind of kills demand and just don't reshuffles it. What kills demand is, in the big picture, it's, if you get into recession mode or capital is not as available or, construction activity, I guess in particular in China, is put more on a hold or going back. I don't really see that necessarily happening. And then you also have, if you get more sudden policy changes, like you have export restrictions, import restrictions. Your export restrictions, you could, for example, say the export from China, if that's impacted by more tolls or limitations in the different countries, and also if some countries want to get more self-sufficient. But in general, I don't really see it as a very negative.
Yeah. Simon, the Red Sea, is that opening up, or what's the picture looking like from Greece, southern?
Well, I think again, the stuff that very interesting stuff I heard this morning on the Suez Canal in particular. I think taking out container shipping, because I have no real angle on the liner side, but on the tramp market or the tonnage provider side of things, let's say, there are some nice figures. December was better, 55% up on dry at least, year on year. But that's 55% of nothing is nothing. So it's not huge amounts, and it's still a great deal less than it used to be. But I think that its nuances. It's not suddenly you get a tipping point and fleet utilization drops because of it. It's, certain ships, certain owners, certain managers, certain crews, certain charterers willing to pay more, and so on. So I think, there isn't a tipping point in tramp as there would be in anywhere else, because when the tipping point comes, it's already happened, and you didn't realize it because you're too busy trying to fix a ship, one way or the other.
Yeah. No, I guess my point of view, it happens kind of gradually. This was discussed last year's event as well, and you see what's happened. It will move in that direction, but I think gradually, and at least for dry bulk, the impact, I guess, is estimated to be about 0.5 or 0.7 of the supply side. So there are other elements pulling in other directions when it comes to disruptions as well. So,
Alex, could I ask you to look beyond Trump 2.0? Or the orange swan, as I think someone called him earlier on today. It's a new one on me. When we get towards the end of the decade, is there a time where an aging fleet collides with decarbonisation? And do you think it's coming back stronger this time, given the snapback that we've had under Trump 2.0?
I think there's three layers here. The first one is the large pool of overaged ships that have accumulated over the past 6 or 7 years when recycling has been pretty much non-existent. That's across all segments. Those ships are technically ready to exit the fleet, but they have little incentive to do so because they trade well above break-even levels. Most of them are debt-free, and they can still achieve pretty good premiums in the S&P market, well above scrap levels. The second layer is more structural. If you look at the trading fleet, you'll see that a very big chunk of the fleet was actually constructed during the super cycle, some 20 years ago. So from now onwards, it will start hitting gradually, but it will start hitting critical age benchmarks. And that's across all segments at the same time. Take tankers, for instance. About 1 in 3 tankers was actually ordered during that period. And on top of that, a lot of these ships were constructed at new and tested facilities at the time. And speedy delivery mattered more than top specifications. So in some cases, we might see increased maintenance costs for these ships as they age, perhaps even early retirement. Then you throw decarbonization into the mix, Regulations don't force ships out of the fleet overnight, but they do narrow trading flexibility, and they do increase compliance costs quite steadily. So put everything together, and yes, the next recycling phase will look fundamentally different than the previous ones. No matter what the trigger will be, whether it will be a major shock to the system, an external one, or a slow burn because new buildings keep quietly piling up, perhaps one day leading to oversupply. No matter the trigger, recycling will restart, and it's not going to be a slow process. It will be long-standing and cross-sectoral.
Right. I want to combine that question with another one with you, Kenneth, and that's, and this relates to Western Bulk as well. There are so many alternative ways that you can gain exposure to the freight market. FFAs, time charters, what is the obsession with steel? It seems people want to own ships sometimes for soft factors rather than, firm financial logic.
I think the one doesn't exclude the other.
No.
We like to trade on all parameters, and I think at least the steel gives some more optionality commercially, operationally. You can decide more when and how you trade the vessel. You get access to the spikes. That's what I like about it in particular. With the market utilization potentially going up, it's about locking in some of those spikes. And if you then get in vessels, my view is if you get in vessels with decent cash break-evens, it gives you an opportunity, a ticket to if the market goes up, like Alexandra says as well, demolition will increase as well. And if you buy the FFA, I'm personally quite positive to the FFA as well, but that locks you in a certain time period. There's less optionality related to it. But it can be a good alternative while you kind of wait for the right asset to buy potentially. And also taking vessels on TC rates, that's something we do all the time and in and out. So, yeah.
And with your professor hat on, you teach a lot of sons and daughters of Greek ship owners, I think. And do you see the light in their eyes to be ship owners themselves when they grow up? And what's driving that?
Yes, I do. Obviously it depends from family to family and to group and so on. But I think that there is a desire, partly of what Kenneth's been saying. I mean, there's this excitement of being able to play all the angles. Just keep buying and selling ships. Okay, just don't play around with the other stuff. But I think that also because it's interesting. Because it's not just focusing on one thing. You have to, you come to something like this and you listen to all the different opinions and so on. How do you make sense of all of this? And then how do you make decisions? But also there's, particularly in the Greek market, there is a responsibility of legacy. And there is a responsibility of, there's a Greek saying, Alex, you will translate it for me, I hope. Grandparents are twice the parents. So when the grandparents are investing, they're not investing for their children, they're investing for a life for their grandchildren and the people to come out after them. And this investment horizon is what frustrates so many other people in the market. Because when they are looking that far ahead, a lot of this other stuff gets evened out. So philosophically speaking, when I saw the title of the discussion, I was like, of course there is. And it's never going to change. Because there is always, if you're looking at a small, medium, large-sized Greek company at the moment, which is the bulk of, you should say, the tramp nature of the market, what you're looking at is not just revenues. It's not just these. We need to keep the office going. We need to keep the name going. We need to think about the future. And as new generations come in, and this may surprise a lot of you in the Greek market, they are very focused on green issues, not because of regulations, but because this is what the children want and this is what they're listening to. So yeah, I do see that because it's interesting.
Yep.
I just want to quickly add to that. I also think that the short-term noise is getting too much attention. I think it's only 3 years left of Trump 2.0. For some that might seem, feel like a very long time, but when you're investing in, $30 million in a vessel, I have to look beyond that. And I think the pendulum has a tendency to swing. You could say maybe, in one way you can view it as it started off with Obama, then you had Trump 1.0, then you had Biden with the Green Deal, then you have Trump 2.0, and who knows what's going to happen after that in 3 years' time. And you combine that with the old fleet, and I don't think the IMO initiative and the focus on environmental regulation is necessarily stopped, it's just delayed a bit. So I'm also curious to listen on the next panel on that as well.
Great. Well, that next panel is fast approaching. I've been given the hand of doom, but we've got one question left. And for this, I want you to use your imagination. Transport yourself to, there's another minor conference going on in Switzerland called Davos. And there are maybe a few more billionaires there. And if you can imagine approaching them with one particular shipping proposal where the earnings will justify the price, what would that be? Alexandra first. It's a curveball.
Yeah, it is. Well, the thing is that the disconnect isn't really a flaw in the market. It just makes it a bit frustrating, really, because the playbooks we had become accustomed to, the patterns, the correlations we saw historically, no longer apply, at least for the time being. But opportunities do exist. They're just more selective and perhaps less forgiving. And everyone's looking to invest at the time. One sector I would still be more comfortable looking at the moment would probably be dry bulk. Yeah.
Okay.
And we haven't even discussed this beforehand. So.
Thank you.
Yeah, Kenneth, same question.
Now I would go for a 5-year-old Kamsa, which we just did with good partners, by the way. I think
Here, is that why you're saying that?
Yeah, that as well, I have to say. But
Right.
I think, yeah, the demand prospects for that West Africa story you all know is driving that a lot. And I also think the order book is not looking that bad at the moment compared to other sizes. I also have kind of an interest in the handy segment as well, because that order book also looks quite low.
Perfect. Simon, sell me a ship.
No, I'm going to do something completely different because you asked me to be creative. Short VLCCs.
Short VLCCs.
Yeah. If the Koreans are buying, it's time to go.
Oh, right. I thought you meant... Okay.
Short VL, yeah. I mean, go short on VLCCs. It's 2 through 3, and I think it's not really thought out, and the values are just so way ahead of anything just because of an idea that has been backed by finance. Personal view.
Okay. Well, with apologies to any Korean VLCC owners in the room, that's the end of our panel, and thank you very much for listening.